Many property investors use a partnership as a route to incorporation, but what exactly is a partnership, and should you use an LLP or a general partnership?
How do you meet the criteria needed to move from a partnership to incorporation? In today's episode of the Property Tax Show, we'll answer these key questions.
Hello and welcome to the Property Tax Show. I'm James Poyser.
I'm Nadeem, Head of Tax at Provestor, the Property Accountants.
So Nadeem, in our last episode, we spoke about partnerships briefly. So a question for you, what is a partnership exactly and what's it got to do with landlords?
Yeah, good question, James. A partnership is effectively two or more people going into business together with a view to making a profit. How that applies to landlords specifically is when you go into a joint venture, whether it be with your husband, wife, children, daughters, sons, and with a view to making a profit in the properties.
Okay, so why would a landlord do it? What's the point of a partnership for them then?
Yeah, so partnerships have been around for decades. It's nothing new. You know, we have different forms of partnerships, whether that's a limited liability partnership, what's known as an LLP, or just a general partnership, which is what HMRC refers to in 1890 Partnership Act. And they are very beneficial in terms of tax and how you can actually structure your business from a tax perspective. More recently, it's become more popular because of incorporation in terms of moving your property into a limited company, something we discussed in one of our previous property tax shows, the Ramsey case specifically, how members can actually join together to form a partnership to incorporate their portfolio.
Okay, so you mentioned there about a partnership as a route to incorporation, which I know we'll talk about in a few moments, but do people set them up for any other reason? Is there an advantage to having a partnership apart from it being a route to incorporation in your experience?
Yeah, there can be. Our experience shows us that predominantly for landlords, not really. So if you're running the partnership, the business as a partnership generally, so husband and wife 50-50, you are being taxed as individuals and you're paying tax on an income tax basis. If you were to move that into a partnership structure, for example, you're still going to be taxed in a similar fashion. So from a tax perspective, still in an income tax basis. Generally, what we find that partnerships are more favourable when you have more complex structure or where you have a number of partners or members, what they refer to as, in a more complex kind of business structure.
Right, okay. But I guess, in our experience, thinking about our clients, it's predominantly husband and wife type investors, smaller family investors. So it sounds like just moving from having your personally owned properties to setting up a general partnership, there's not a huge advantage to doing that. But if they're on the route to incorporating their property portfolio, then it might be the right thing to do.
Yeah, absolutely. So, again, one of the things we discussed was the Ramsey case and actually how you can follow the case law followed in that partnership. And if that means husband and wife following that structure to be able to get incorporation relief, then from a long-term planning perspective, it can make sense to go into that partnership, even though there's not going to be any short-term benefits of moving to the partnership. Right. For incorporation and long-term perspective, it certainly makes sense.
And why is that?
Well, we talked about, again, the use of a limited company and Section 24, and actually, the benefits of a limited company as opposed to having properties in your personal name. One of the things that puts a lot of people off is, of course, the costs associated with moving properties to a limited company, whether that's be legal or commercial or the tax, stamp duty, capital gains. Whereas this partnership route allows you to reap the benefits of a limited company without having those initial costs to worry about. And
I think from the last episode we were talking about the fact that's because you are demonstrating the fact that you're running a business rather than your portfolio simply being an investment, and that's the route to incorporating without these costs.
Yeah, absolutely. So a partnership is what we're trying to do is we're trying to identify the partnership to be a business of sort, and it solidifies the husband and wife or the two partners' relationship to HMRC, that it's actually been run as such a business. Hence why you'll hear LLPs or partnerships being branded, because they have a little bit more weight behind them as a business, as opposed to just jointly owning a property.
Okay, so I think we'll come on to the LLP question and section, because I know that section in a moment, because I know a lot of people are quite hot on that topic at the moment. But here's a question that's just sprung to mind. So we're talking here about husbands and wife with established portfolios and going through the partnership route. That sounds really straightforward. What if you are investing properties by yourself and you haven't got a husband, wife, spouse, or other partner? I guess a partnership is a bit of a dead end when it comes to a route to incorporation. Is that right or not?
Yeah, it's a good question and a very common question, because people clearly want the benefits of that incorporation, but then when we talk about partnerships, and partnership being exactly that, two or more people, it's a bit of a sticking stone for some people, and unfortunately that is the case, because The case law that we're trying to follow is to stipulate that a business is being run as a partnership, and that does require 2 or more people. So we're not saying corporations out of the question if you are a lone wolf, as you call them. Yeah. You can still incorporate. There may just be a cost associated with that you may not be able to get the full reliefs available within the partnership route.
Okay, yeah, makes perfect sense. Okay, so let's then jump back to partnerships. So my understanding is that there's 2 different forms of partnership. There's a general partnership and an LLP. What's the difference between those 2?
Yeah, and again, this is nothing new. We're not uncovering anything new with these 2 partnerships. They've been around for a number of years. And what you'll generally find is that the biggest difference between the 2 is that you have a limited liability partnership, and exactly that, your liability is limited to the amount of financial contribution you make, and that's an LLP. And you generally find that with firms which have a number of members or partners. So you typically find a lot of accountants, solicitors will set up with such a structure because you'll have a lot of partners or members who are part of that business. Whereas a partnership is not limited, and effectively your liability is effectively what you put into the business, which is 50-50 or whatever your percentages is. And less regulated, of course. So an LLP is more regulated. You have to register with the company's house, submit financial accounts, etc. What we find with a lot of our clients and landlords specifically is that when we're in a partnership, it's mainly for incorporation. And that requires a partnership only to be in place for sort of 3 years plus. We're not talking about this being a long-term business decision. And the need for an LLP is not necessarily the correct thing when it comes to incorporation. Okay. Yeah, because we're talking about a more vanilla setup here in terms of husband and wife or maybe 2 or 3 members of the partnership, and not all the complexities that an LLP has that we require.
So just to jump in, so a lot of people are talking about LLPs and kind of recommending that this is the route that you must go down to incorporation. Why is that? There must be some benefit, right? Why are people recommending LLPs so forcefully?
Yeah, absolutely. So going back to my original point, we know the Ramsey case stipulates that it needs to be a business, okay? And what we're trying to do is kind of future-proof any potential issues by saying we're in a partnership. Now, actually, there's been many a case where actually husband and wife have been declaring their properties jointly on their tax return for a number of years. And actually, we've argued with HMRC that that's actually a business in its own right. I mean, this is without even having a partnership in place. Right. So an LLP is actually sort of really kind of tightening the bolts by saying, well, actually we're a regulated, structured company. We submit financial accounts as a business in its own right. But actually for incorporation purposes, all we're trying to identify is that it's been run as a business. So a normal partnership absolutely suffices. It's all registered with HMRC. You have your unique tax reference number. Yeah. Back to your question in terms of why LLP is being sung about and promoted. There are some other advantages in terms of LLPs, in terms of things like capital allowances and being able to use sideways relief. Maybe that's something we could talk about in the future. Getting a company car, for example. But again, when we're talking about property landlords and investors specifically, we're not going to be in the partnership for long. It's not a long-term plan. It's a short-term plan for us to incorporate. And those advantages probably get far outweighed by the fact that we just want to move away into an incorporation business sooner rather than later.
So I assume, and we'll come on to cost in a second, but I would assume then that the cost of incorporating and running an LLP is greater than just having a general partnership on your self-assessment tax return.
Yeah, of course. So the things to consider is that like an incorporated business, it's registered and it's regulated by Companies House. You then have financial accounts to submit year on year, your company tax return, whereas a general partnership is just you continuing as a sole trader, effectively declaring your income on your self-assessment. So from a cost perspective, much cheaper.
So I guess, reading between the lines, it sounds like an LLP, it's not a silver bullet that HMRC can look at an LLP and say, all right, that's it, you're definitely in business. It's about all the things that you're doing, and it's just as viable to be a general partnership, not an incorporated partnership, not an LLP, and pass that bar with HMRC to demonstrate that you're in business and take you on that route to incorporation.
Absolutely. And this is, again, going back to the Ramsey case, which we've already discussed, we're doing a lot of things about case law here, identifying the types of things which Miss Ramsey was doing in her business to demonstrate that it was being run as a business. Yeah. And Miss Ramsey was not running an LLP, may I add.
Was it a partnership? Was it registered as a partnership, or was it a...
No, it wasn't registered as a partnership either. Okay. Yep. So, but the business was run for a number of years with her partner in a way where she was the sole earner. She had no other forms of income. Yep. There was nothing about it that was sort of a hobby, or it was fully commercial in terms of the way it was let. She was spending 20 hours per week looking after the properties, and the courts agreed that it was a business in its own right.
So it's about, that's really interesting, right? So you're talking about LLPs, we're talking about, general partnerships. We're holding up the Ramsey case, and actually it's about stepping back, looking at the facts, looking at the characteristics of how that business was run, and then saying, actually, yes, it was a partnership in all but name, which allows us to take advantage of those tax reliefs. Exactly. Which sounds like a good reason to hammer home the point that an LLP is not going to be that magic ticket to incorporating your portfolio.
Yeah. Fantastic. And if we flip that and say, well, an LLP is in place, you could have an LLP in place, but actually not meet the criteria of actually running it as a business, and you could still fall foul of the incorporation relief, even in an LLP.
Okay.
So that's something to consider.
And what kind of things would be the hallmark of a sham's a strong word, but an LLP which isn't in the true spirit of running an LLP? Yeah. What are the things that you think HMRC would be looking at?
So the classic signs would be exactly the Ramsey case point. So you could have an LLP in place where both partners have a full-time job, respectively earning a high level of income, and this is almost like a side income in terms of the partnership. So it could be an established LLP earning high levels of income, but if you have a management company looking after the portfolio within the LLP, you have all members in the LLP having full-time jobs and earning money elsewhere. Yeah. The argument would be that actually it's still an investment business, as opposed to it being a business in its own right.
Yeah, okay. I think that's a really good thing, a really good point to drive home, is the fact that it's not just about incorporating your partnership and it's plain sailing. It's the fact that HMRC will look at how your business is run in terms of whether you can go through to incorporation or not. Okay, so let's just talk a bit about kind of the details then, in terms of how much it costs, how do you do it, what's the process of setting up a partnership?
Yeah, so setting up a general partnership is fairly straightforward. It's just like registering yourself for self-assessment or when you register yourself as a landlord with HMRC. It's effectively just a form-filling exercise. You obtain then a UTR number, a partnership UTR number, which is in addition to your personal UTR number. You then have a requirement to obviously complete your tax return every year. So you have a partnership tax return, which you submit in conjunction with your self-assessment each year. And again, the costs of submitting a partnership return should be pretty similar to submitting a self-assessment return at the end of the year. So substantially cheaper than LLP, which requires financial accounts and company tax returns to be submitted every year to Companies House. So yeah, from a filing perspective, much cheaper. Again, setting up an LLP will require, of course, going to deal with the Companies House directly and setting up and formalising a structure with them.
Okay. Does any of this impact mortgages, by the way?
Yes, so a good point. So, we're talking about partnerships being not a separate legal entity, because your partnership is effectively yourself, and an LLP being a separate legal entity. And the types of things we need to consider when creating a partnership is effectively the portfolio that you're taking into the partnership. And the fact that an LLP is a separate legal entity will mean that you will potentially be transferring those properties to an LLP, the separate legal entity, which may well be you having conversations with your existing lenders, breaking out of early repayment periods and having fees associated with that. So that's something you certainly got to consider, whereas opening a normal partnership, you're effectively still trading as yourself. You're just creating this hybrid this umbrella of a partnership above you in which the property remains in. So yeah, absolutely valid point there to consider in terms of setting up an LLP. Yeah,
and it doesn't sound like, so you've alluded to the fact that for many people this is, you'll run a partnership for a few years, I think you've said 3 to 5 years on the route to incorporation. And there's a lot to consider there with the incorporator, the LLP, the fact that you've got the accountancy fees, you've got to consider the mortgages, this, that and the other. It sounds like a lot of extra effort compared to just a general partnership.
Yeah, absolutely. And like I said, we would advise LLPs for the more complex structures. What we find is that when it comes to property landlords, the vanilla partnership absolutely works just as well.
Yeah, brilliant. Okay. I think that's everything that's sprung to mind. Nadeem, anything you think that I've missed?
No, again, I mean, incorporations generally are a complex area. There's a lot of information out there which we know landlords like to read and try to take on board. Unfortunately, it's a type of thing where if you're going to invest your time and money into it, make sure you really understand what you're getting yourself into. Because it's not just necessarily the tax things you need to be concerned about, it's also the commercial, the lending, the legal costs associated with that. And of course, when you are then going into a partnership, you then have another individual or individuals involved within your business. So understanding what the consequences is for them as well as yourself. So again, just making sure you get the relevant advice to make sure the partnership or long-term strategy of incorporation is right for you.
Great, thank you, Nadeem. I hope you found this episode useful and interesting. It's quite a good insight into partnerships. If you have liked it, hit the like button below, subscribe to our channel, hit the alert button so you get an alert every time we put a new episode live. If you've got any questions, put them in the comments below, and Nadeem and his team will be happy to help you out. And if you want some more specific advice, we also offer property tax consultations one-to-one with Nadeem and his team. So head over to the Provestor website to find out more. Thanks a lot for watching, and hopefully we'll see you next time on the Property Tax Show.